Bust it.
Hi there. Well, my name is Scott Rockins, and I'm a mortgage broker with Dominion Lending Canada, and I wanted to give a few tips today to my realtors. I'm in touch with quite a few realtors, and some in the north of BC and some in the south, so my intention is to continue giving some tips that have to do with mortgages, but will help you in closing more deals and hopefully doing more business, and helping your clients buy prudent homes and have prudent mortgages. So I had a few conversations with some of my realtor contacts lately, and I wanted to share those conversations with you, and just because I think they may be of value to all of you. And I'll also be really interested in hearing some feedback about other topics you might like to hear about. So the first conversation was really about how much does, say, a $10,000 in purchase price affect my client's mortgage? Well, there's a few variables there, so I'm going to be very general here, and I suggest when using this information with a client, you also say, this is very general. So, roughly speaking, you can get a mortgage in the market right now, at the beginning of 2011, for about 4% or less, depending on your lender and your qualifications. So roughly speaking, if you're getting a mortgage at 4%, $100,000 a mortgage is just over $500 in mortgage payment, or $10,000 in difference in mortgage is around $50 difference in mortgage payment. It depends on how much money the client's putting down, of course. If they're putting, say, 20% down, then adding $10,000 to their purchase price actually costs them $2,000 out of their pocket. If they're putting 5% down, it only costs them $500 out of their pocket. Still, $500 might be a lot more money to the people putting 5% down. So you have to consider the down payment, but the change to their mortgage is going to be about $50 for every $10,000 in price. So you get a deal and you're really close to closing it, and the two sides are about $10,000 apart, and you just can't get to an agreement. This might work for either side of the transaction, but if you're a buyer, you might say, look, I know this is a bit more than you want to pay, but it's probably going to amount to, say, $40 or $50 in your mortgage payment. We'll check with your mortgage specialist. Hopefully that's me. And you know what? I'll tell you what, for the first year, maybe I'll hire a maid to come clean your new place, or I'll buy you a gym pass. It really depends on the client there. If you know your client well enough, you might be able to suggest something that they really like, that they might not otherwise do, and just say, yeah, you know what? Maybe I'll pay $50 more in a mortgage, but my realtor's going to make my life better too, so it might help you close a deal. And even if it doesn't help you close a deal, it'll add value to your conversation with your client, that you know a bit about mortgages, and that if you have to, you can bring in an expert to help them with that. So the second conversation has more to do with qualification for mortgages and terms. So when you're listing homes, I know it often comes up that your clients have a penalty because they've taken a 5-year mortgage, because the most common type of mortgage is a 5-year fixed rate mortgage. And it's really the case that this isn't the best mortgage for everybody. It's just that it's the most common mortgage, and the banks love selling it because they've got your client locked in for 5 years. The best way to choose your term for your mortgage is think about your life. If you're going to buy this condo, and you're planning to have kids in 2 years, and you're going to outgrow the condo, maybe a 3-year term is right for you, not a 5-year. But there are many reasons why clients get stuck in these 5 years. First of all, they're most competitive. The best rates usually are on 5-year terms. Banks really compete for this business because they get to keep it for 5 years, so they can count on that interest. And so it's very attractive to the bank that way. The other thing is, with the rules in Canada for financing homes, it's actually easier for your client to qualify for a 5-year fixed rate mortgage than it is for any term shorter than 5 years or a variable rate. So if your client is, say, purchasing at the upper end of their affordability, they're probably going to get forced into a 5. And the reason for this is very reasonable. The government wants to make sure that should rates increase over the next few years, they can still afford their payment if they have to renew, or that they won't have to renew. So if your client's taking variable rates, or maybe they want a 3-year term, it is going to affect how much of a home they can afford, or how much of a mortgage they can afford. So that's why people end up in these longer terms more often than not. But also, ask your client what type of mortgage they're going to take, and it's a good place to bring in your mortgage expert. So I hope these tips have been useful, And I look forward to speaking with you more. Also, if you have any feedback about other tips you'd like to hear about, please let me know. My contact information is right after the video. Thanks again. Have a great day.